This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
It's time for the chart deck. Let's get to it. Listeners, those of you that want to download the charts, you can go to the MacroVoices website and click the download button, or you can get it out of the Research Roundup email. Now, when looking at that S&P 500 on page 2, we had quite the bounce off of those lows around 3,600. It was a very rapid 200 S&P point rally from an incredibly oversold market. But while it was a pretty sharp run on the upside, I still think there's more of a bounce to go. Like, it would be very natural for this bounce to even get to 3,900, and even if it's robust enough to 4,000, and still be in primary downtrend and still have the potential to roll over and fail. Anyone who's hanging on here that this is already a bottom just because we bounced this way has already forgotten what the other bear market rallies have looked like. We've seen this rally back in March, which was almost 400 S&P points. You had that May rally, which was about 300 points. And then, of course, that robust June and then subsequently July rallies that were, 500 plus points. And each time that market rolled over and sold again. So while we are bouncing and while it certainly has room to go for another week, a couple hundred more points, I still think that it's too early to be already calling a market bottom. Now, Nick, I know you've been doing some analysis on the S&P. What are you thinking?
Thanks, Patrick. Yeah, no, I've been looking at SPX, which as I'm talking right now is at 3780 roughly. Analyzing the expected move based on a straddle cost for the October 21st OPEX, we're looking at about a 170 point move in either direction, which denotes about a 4.5% move up or down. So the upside potential here is about 39.50, downside around 36.10. And the expected move for the November 18th OPEX, which is very important to look at because this factors in the U.S. midterm elections on November 8th. OPEX is November 18th, is about 280 points in either direction, which denotes about a 7.4% move by November. So we're going to see some volatility likely into November for sure. Upside potential there is 4,060. The downside potential is 3,500 or so, which is pretty key support as well. Looking at the put to call interest, 1.74. The market's pretty adequately hedged overall. And the IV right now is 26.5%, which denotes about 1.65% average daily moves. Looking at the NASDAQ though, which is spot right now on 281 roughly on triple Qs. The 200-day moving average is right around 300, which is very, very far away from where we are right now. But for the November OPEX, again, factoring in midterm elections, the expected move is plus minus 25 points on triple Qs. So upside there is 306, 307, downside 256, 257 or so. And also remember we have earnings coming up as well shortly too. This denotes for November again an 8.8% move up or down into the midterm elections. So we should see a lot of volatility coming about in the next couple of months. And onto the VIX now, I guess.
Yeah, no, we should definitely take a look at that VIX because it's surprisingly sticky up along the top.
Yeah, well, right now, as I speak, the spot's around 29 or so. And this denotes expected moves each day of about 1.8%. Now, looking at the longer-term chart, if anyone pulls up a longer-term chart of the VIX of about 20 years or so, what you'll notice is that it taps 35 pretty often and comes back down. This year alone, just some food for thought, we've tapped it 12 times already and reversed lower. So is it possible that we're heading back down on the VIX, which means we might stabilize for a bit? Possibly. However, keep in mind, we do have Q3 earnings coming up, as well as the November midterm elections in the United States. And those will be probably volatility-inducing events.
Yeah, Nick, I mean, it's going to be really interesting to see how this plays out. Overall, with the S&P 500 bouncing this way, your target zones are pretty accurate. I think a move up towards 3,900 plus is still possible, but the one thing all of our listeners need to be aware, with the volatility this high, 50 to 100 S&P point swings intraday is a par for the course, right? Anyway, Eric, on the next page, we have the dollar index. What are you thinking?
Patrick, we've seen the blow-off top in the dollar index just as expected. Now the question is whether the rally resumes now that we've come back down to the trend line that was in play before that blow-off occurred, or if this was a major top and a trend reversal point. Now, it's still too early to tell that from the chart, but I'm going to posit that it is profoundly important to watch closely and see what happens next. Because if this turns out to be a major high for the dollar, meaning that we've got a trend reversal and we're going to be trading down for the next several months, okay, that's one really important message. On the other hand, if we see the rally resume, and particularly if we move above this recent blow-off high, and particularly if we go over 120, that says to me that we've got a really serious runaway dollar inflation situation that could crash the global economy. That's not my base case. That's not a prediction. I don't think that's what's happening. I'll be surprised if that does happen. But it is so important to watch, because if the dollar puts in a new high above that recent high, I think it means we've got a really serious problem. I think it's unlikely that will be the case, but I'm watching it very carefully.
Yeah, Eric, when looking at this dollar index, I mean, we had obviously an incredibly overbought dollar the other week, and it was due for some sort of a mean reversion or correction. That's just what the markets always do. What was interesting is a pullback to 111 or 110 was just simply a 50% retracement of the prior advance from August and September. What will be really interesting now is, as the dollar index turns back up here, will it be able to get back above 113 on the upside? I mean, once if the dollar index was to gain any traction back above 113, back to 114, that breakout to a new high could set in motion another rip. It's going to be so important to see whether the bulls still have gas in the tank. The euro is rejecting along its parity level. It's just such a critical moment.
Now, Eric, I know that you spoke a lot about oil in this session. On the next page, we have the charts on oil. Patrick, what are you thinking regarding this?
Well, Nick, I'm pretty impressed that the bulls were able to clear the 85 level on the upside. Obviously, OPEC being talked about has put this to the forefront, and traders are starting to track this. But the real hurdle for me is the $90 level, largely because a huge amount of the volume through July and August transacted around 90, and there was a big consolidation in that zone. And when we broke down below that $87, $88 level to break lower, the natural bounce here now is back toward this 90 level. If oil was to reject below $90, then the primary downtrend remains intact. But the bulls really do have a shot at this here. But it really does have to show that they are buying dips and all corrections are quickly accumulated, and they're consolidating the prices solidly above the 90 level. We're going to see it above all of its key moving averages then. It'll be above key fib zones, above key volume profile levels, all sorts of things that would start to actually create some bullish buzz on crude. So let's watch that 90 level going into next week.
On the final chart, we have gold over here. Now, Eric, what are your thoughts?
Well, we hit the 55-day moving average on Tuesday, and it seems like for now at least we're stalled out there. That was at 1734. And if we can get past the 55-day, the next resistance level will be 1767. That's the 100-day moving average. But still, even if we touch that level, we're still below the previous high. We've got a long-standing trend of lower highs and lower lows. We need to see higher highs and higher lows before we can confirm a trend reversal. So right now, all I see is a promising bounce, which I hope continues. But frankly, I'm not going to get excited about this gold market until I see it move above that previous high around 1827 or so, which happens to be just about where the 200-day moving average is. So if we can get above that, well, okay, now we've got above a significant moving average and a new high higher high to replace the series of lower highs and lower lows, which we've been seeing for the last several months. Those are the things that need to happen in order to get excited about this market. Until they happen, as far as I'm concerned, the downtrend continues. We're at a bounce. It looks like it might even be reversing right now.
Well, Eric, you know what? When I look at the gold chart, and you just simply overlay just the path from, let's say, the way all cross currencies, including the euro, have behaved, it really just shows that gold has literally been tracking as a cross currency to that U.S. dollar. And my view on gold really is that if the U.S. dollar has another rip, then gold has every chance of going back down to retest its lows. I really think that in order for gold to have a bull scenario, it's going to need a short to intermediate high of the dollar to be in, and there's simply not enough technical evidence that that is the case. And so while it's been a really good push on gold and much relief after just months of sustained selling, and at this moment, if we see it roll over here below 1750 and the dollar's ripping, it's still vulnerable for, at minimum, a double bottom retest along the downside. So that's certainly something to keep in mind.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last page of the chart deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.